Hello and welcome to Trading with Technical Indicators. My name is James Boyd. Today's date, July 28th. Hopefully you had a good weekend. We're right back at it. I spent a lot of time with the family and it was good times. So just real quick, did play a little pickleball, okay? I still think tennis is better. Anyway, hello Lola. Len, hello to you. Gary, Amun, Will, or WW, got JP, Josh Pink, David, Naya, Vic Turner, and many others. Welcome to all. Just real quick as we get started, we also have Ben Watson with us in the chat, also known as the Ben Watson. So just real quick as we get started, remember if you have questions, go ahead and type those in. I actually did get some questions already, wrote those down, want to get to those. But as we go through the session, if you have questions, just know Ben Watson, BW, will actually be answering those questions in chat. And just real quick, Ben and I, we do post educational content on X. There's my handle. Ben will post his handle in the chat, so follow us there. Real quick as we get started, remember that the information here is provided for general informational purposes only. Should not be considered an individualized recommendation. When we talk about stocks, but specifically options, remember that options carry a high level of risk and are not suitable for all investors. Short selling is an advanced strategy. If you consider that, we won't talk about that here today, but some investors might consider that. When we talk about examples, we will do those on the Paper Money software application. And also remember that investing involves risk, including loss of principal. Now, when we also talk about here today, some of the points I want to kind of get to is, number one is I want to talk about some of the reactions post the earnings. So here we are in the earnings, okay? Right in the thick of it. And sometimes the earnings the reaction to the earnings does not go well. And the stock gaps down. I want to talk about kind of some gap down reversal setups that might be happening. We'll look at two historical ones, but I want to also talk about one trade that we're going to try to do in the Paper Money for a class purpose. And I want to kind of maybe talk about a little reversal setup or what the investor might want to look for to say, hey, we got past the earnings. I'm going to invest in it even though it gapped down. What might the investor look for? So that's going to be the main point that we're going to focus on here today, because not all reactions on earnings are positive ones, despite what the earnings are. Now, we got a big week of earnings, as you know, Apple, Amazon, among other stocks, and we'll get to those. So just real quick, let's go ahead and hop right in. Let's take a quick look at just real quick the indexes. Now, again, I think it's very important to be routine-based, okay? So notice kind of when we get together in the class, it's not kind of bouncing all over with different lists. We're going to go the same list, and we're going to kind of objectively actually focus on where's the relative strength, where does the technician see the setups. So what I'm actually going to do is I'm going to go to the Market Watch tab. This is the index list. We just call it list number one. Excuse me, list number two. List number one is a different product, which we won't talk about. So list number one is what I look at, okay, first, but it's not related to this class, so we're not going to pull it up. List number two is indexes. So if I forget what to look at, I just go 1, 2, 3, and so on. Okay, so that we all caught on. Now, what I want to do is kind of look at the indexes in general. I'm looking at the SPX, NDX. If we take a look at the Dow Jones and the Russell. When you look at this, and again, I hate to sound like Groundhog's Day, but many of you might say, James, just keep sounding like Groundhog's Day. Trend number 3, some of you are falling in love of that trend 3. And I know you're saying, James, just have it go like that to the end of the year. This is the trend. This is the trend on the daily chart. This is price above the 10-day exponential moving average and the 3rd-day simple. The trend weekly is also significant because you don't want to just maybe have trends on the daily chart per se. You would actually like that trend W is trend weekly. And so we also have the trend weekly, trend 3 as well. Now, outside influences, right? We have the semiconductors, that's trend 3 right there. We include that in the index. We kind of tuck that underneath the NASDAQ. We could even also put that in the sectors. The VIX, okay, like a flat tire here in trend number 1. Many investors like to see that in trend 1, VIX is low and maybe even trying to go lower. I think last week we punched into the 14s. It was unbelievable, okay? So when you have VIX falling, you typically have indexes rising. Quick look at these on the index, and then we'll actually hop to the third list. When we actually look at the Dow Jones, which is kind of the index we were kind of looking at last week, we were kind of monitoring the moving average crossover. This is where we were, last week? It was right there. We had the 10-period moving average green. The moving averages were starting to pinch. The next day on Tuesday, we actually saw on the 22nd, a little crossover with the 20-period moving average. Again, this is what happens in real life. It's day by day. And Wednesday, doing to the upside, there's your crossover with the gap setup. Now, if you take a look at Friday, we really had a close higher day, not a close above the high of the low day, okay? But today we did gap up a little bit higher. So some people like to trade gaps. They had a close higher day Friday with the gap here this morning. SPX will fast fire, broken record, okay? Brand new high. Could you imagine if you weren't paying to the stock market right now? Ooh, okay. That not paying attention has been expensive, okay? SPX, brand new high. NASDAQ, if we take a look at that, brand new high. And if we look at the Russell, if you like to look at smaller caps, you're going to see that they're still kind of fighting through that 2250 level, but we did make a brand new high about 4 days ago, okay? So let's go back to, so first off, when we look at the indexes, the takeaway is most things are going up, right? Now, if we take a look at the market watch, let's go back to list number 3 just real quick, and there's 3, okay? So if I look at list 3, I'm now going to come down to this and say, okay, so what do we got here? Now, first thing I want to kind of say, SOX is included in the sectors as well, okay? If you like to trade a lot of technology, semiconductors, you might include those in the indexes. I know Kevin Horner likes to. I just do it because I like to do it, okay? But I also put in the sector list as well. Notice gold is in that list as well. Some people feel like gold or precious metals can be a sector by themselves, okay? So the one thing I do want to point out is communications. I want to say this right up front. Communications was down for the week just slightly, okay? If you pull up that chart, and it depends on which one you look at, it kind of lagged a little bit, dropped. Charter communications was down massively, okay? So if I pull up that chart, IXC, $ IXC, if I get that right, there it is, yep. And you're going to see that it was down from where we were 3 days ago. Which stock in there pushed it down? Well, Charter Communications, speaking of earnings, had a pretty nasty drop down, and it drug that space down. So if you're saying, why did it go down? Thanks, Charter, okay? So we're going to talk about some of those gap downs in just a moment. Let's go back to it. If we kind of said, well, what do we have here happening today? SOX is still at the top. Energy is trying to get a push. Oil not necessarily really ramping it to the upside, but trying to get a lift. There's consumer discretionary, okay? Did we say Amazon? Okay. Still getting a push. Notice we actually still have technology. If we could have a ticker, we would also include, listen, transportation, okay? Now, since we don't have that ticker for transportation, we would use the industrial sector as a proxy, somewhat, for transportation. Now, you could have a list of transportation. I can't just put that in there. I don't have a transportation index here, okay? But we want to highlight transportation. We would include actually industrials. Financials are fine, okay? And if we take a look at, let's say, probably the big one, it's really still discretionary. It's getting a little push. Do want to keep an eye on basic materials. Basic materials kind of trying to form like a little short-term pennant, but there's a couple sectors here that are still quite strong. If we said which ones are stronger than the relative strength of the S&P 500, okay? Well, it's technology. Energy's been getting a push. There's the semiconductors, there's industrials, and there's your discretionary. In the last 5 days, that's where you really had the strength. And of course, we can go back to the 10-day and say where we had the strength. If we said in the last 10 days, where's the strength been? The answer has been healthcare. Now, I have not said the word healthcare in a long time, okay? Healthcare is in the basing pattern trying to reverse. Some investors like to buy maybe bottoms or basing pattern breakouts. Keep an eye on healthcare. It's not going to be a focus of ours right now, but that is something in the last 10 days it's trying to reverse, okay? Now, any questions Yeah, so if we brought that up, let's just bring this up. Dollar sign, if we included this and said dollar sign DJT for the Dow Jones Transports, pull that up. What does that look like? We could look at that. Now, I'm not sure if that's going to be exactly like the transportation sector, but we could kind of use that as a proxy. Sure. Now, I'm just double checking what it looks like, kind of how closely does that represent? So we're comparing the Dow Jones Transportation Average, and we're comparing that to probably, which many of you think about as something that's really the transport basket. It's close, okay? It's not perfect, but I think we could actually include that. So let's do that. Whose idea was that? Crispy, of course it's your good idea, okay? So we'll include the transports there. Again, different stocks and transports than industrial, but some similarity. Everyone think, Chris, okay? Now, what I want to kind of now do is let's kind of talk about kind of what we mentioned we want to bring up here today, which is kind of talking about some of the stocks that gapped down last week. Example given, we had a stock, a small company we've never heard of before called Tesla. Okay, and before I even go there, I want to talk about two past examples. But just know what we're going to do is we're going to work back to Tesla. So let's take a look at two past examples, and let's kind of talk about what happened sometimes on these earnings when you get gap downs, okay? So what I want you to kind of notice is on a stock like, let's say, and I'm going to talk about this in terms of going down before the earnings. I'm even going to talk about just kind of pullbacks in general. And then we're going to look at Smuckers and then work our way to Tesla. So let's start with Boeing, then look at Smuckers, SJM, and then go to Tesla for our first trade example. So sometimes what you're going to notice is if investors are actually kind of cautious, or if they hear rumors, which they don't know are completely true, if they actually start to hear, for example, that or maybe the company pre-releases their earnings of what they think the company could do, some investors could get out before the earnings. Now, some companies do that, okay? The quarter closes. They typically have 2 to 4 weeks to actually kind of get the updated numbers and then announce the earnings. Now, what you're now going to notice is that stock sold off prior to earnings. Going into earnings, it recovers a little bit of it. You're now going to notice on this chart, there's some gap downs. Now, why on earth is this brought up in technical indicators? Well, one of the technical indicators that technicians look for is price. Now, when we talk about price, we're really talking about breaks of resistance where the price fills in the gap of the gap down or, okay, rallies above the old resistance and then gets above and reverses the trend back to the upside like the gap down never happened, okay? So what you're now going to notice, I'm going to label this as number 1, resistance, number 2, resistance, and what you're going to see is it got above on the earnings. What was the reaction? It gapped up, and it gapped up through both levels, and the stock kind of took off, okay? Now, what's another reaction? Look at the hole in the chart. Look at the gap down, right? Remember what we kind of said, when you get a gap down, what becomes the level of resistance? Well, it's usually where the body of the candle is, okay? So if I draw the body of the candle all the way over here, it's probably right around low 200-ish. Well, what do you notice on this day right here? It actually gets above the first level of resistance. And what happens is, we'll label this as number 1, and this 216 was that double top high. Well, it goes through number 1 and it slices through number 2. So why are we paying attention to this? Well, sometimes what happens in the short term is opportunity for other people to get in. Let me give you an example. Let's say my house is $1 million, hypothetically, okay? And let's say in the short term, my prices for my house, my neighborhood drops down by 50%. Horrible for me, okay, on the balance sheet, but opportunity potentially for someone else. Someone else was looking to get in, they moved to the neighborhood, if I was willing to sell for 500,000, okay, which I'm not planning on it, but if I was willing to sell 500,000, they might take that opportunity and say, spank you very much. Well, it happens in the stock market a lot faster than that, right? So we get these kind of a nervousness of what the earnings is, gaps down. Notice actually where the gap down is, that becomes the first level resistance. And if you can get the price above it and the price above the next level, you're starting to get some reversals. And on Boeing, we've seen that, okay? So I think a lot of these gap downs, they're probably the least talked about, but for some technicians that have experience, kind of interesting, okay? Now, if I take a look at this, tell me where the resistance would be on Smuckers. More recent here, okay? Where's the resistance on Smuckers? Can you tell me where it is? We can see where the hole is on the chart, right there. There's the hole. But where would you draw the resistance? Do you draw it actually at the bottom? Nope. Where do you draw it? We draw it from the open of the red candle or green candle, okay? It's going to be the open, and typically the gap down day tends to be a red candle, okay? And so we draw it from the open of the red candle. So this becomes resistance area number 1, okay? Now, if the price can get above 105, it's working off some of that negativity in the shorter term. Now, if we kind of go back and look at this, we can kind of see on the bottom we're basing. And all of a sudden, if we go back and kind of take a look at this, what's starting to happen now? Okay, now let's draw that resistance again. Now, by the way, with so many earnings, do we think that we could see the pattern? Do we think we could use price as an indicator of changing sentiment? That's the point of this class. Well, if I draw the line horizontal from the open of the red candle all the way over, we can see on the bottom here that there was low, double bottom, 2 touches. This one is not as low. Now, calm down. So many technicians love to see that tilted up W pattern. And if we get above the middle of the W, doink, on that day, we see a shorter term brand new high. You like to read short-term price action? There it is. If we take a look at these higher lows or equal lows, there was a new plateau of support built at 102. And all of a sudden, it kind of just starts to break out and reverse. But a lot of investors don't know where to look. So number 1, we need to see a gap down. Number 2, we need to draw a line at the open of the red candle. And if you can start to actually see, for example, the price breaching that level, the sentiment in the shorter term is changing. Now, does that mean that the investor cannot invest down here or here or here? If you're trying to build a position, that could be an option, okay? Sometimes what people do is they say, James, I really want to see us close above where the gap down is, okay? Now, what I'm going to do is let's go back to Tesla. No, let's go back to Tesla for just a moment. Now, I want to take a look at this. Tell me where, learning lesson, where's the resistance on Tesla? Where is it? So first step we got to actually do is find out where's the gap down. And it should be easily identifiable. There's the gap down, okay? Step 2, where do we see the resistance? Well, usually the gap down is going to be a red candle day, hence the sell-off, okay? Now, let me get technical with you here for just a second, because it could happen, okay? If the gap down is a red candle, we're going to draw the line at the open price, and we said that. Hypothetically, let's say that the gap down day is a green candle. We're going to draw the resistance from the closing price. I know that might be confusing initially. I don't plan to see it that much. But wherever that body of the candle is, that's where we're going to draw it, okay? Most of the time, not all. We're going to draw from the open of the red candle. Draw the line. Get above that line, could get a reversal. If that gap down day is a green candle, we're going to draw it from the closing price of that green candle, okay? That body of that first gap down day is significant. Okay, if you kind of really brought this down to kindergarten version, which is not bad, by the way, what we just want to do is on that first gap down day, just get above the body of the candle. If it's a red candle, it's the open. If it's a green candle, it's the close. Moral of the story, just kind of give me the easy version. We want to get above the body of the candle when it gaps down. All right, there you go. Now, what did we actually see in Tesla here? Now, the other day we saw it gap down. Elon Musk actually came out and said the next quarters are probably going to be horrible, okay? Well, what did investors do? They actually took the opportunity and said, hey, maybe I'm going to try to buy in on a little fundamental softness here. And the stock, what you're going to notice is got above 310, gapped up the very next day. And here we are right back to the moving averages. Now, some investors, they might say, James, I'm not going to do anything until I want to see us fill in this gap here, get above the 330. Let's kind of start to kind of build two positions. And what I want to do here is I want to build two positions of verticals. The first position is really going to be a short put vertical, a little bit more forgiving, okay? The second position is going to be if we get above the 330, we're going to add another vertical to it, but it's going to be a long call vertical. The first vertical is more probability based. The second vertical is really more profitability based. You're trying to have a higher upside potential. So what we're going to do in this trade on Tesla is we're going to go right back to, we're going to go right back to the trade tab. We're going to actually take a look. We're going to type in Tesla, and we take a look at, let's say, Tesla. You're now going to notice if we go to Tesla. Now, notice that the 15 August, if we looked at any stock, the monthly options for August are now below 20 days. So this is going to be where our positions, when we look at the monthly options, we're now going to go into the Septembers, the monthly options, okay? Does that mean we can't look at weeklies? No, it doesn't mean we can't, but if the monthlies aren't liquid, there's a pretty decent chance the weeklies aren't liquid. So we just kind of start there as a foundation. We're going to go to the 19th September. We're going to go look at, let's say, doing a put spread with a delta between 30 to 40. Now, there's a couple options, 305, 310, 315, 320, a couple of them. If we get a couple of them, let's say the investor says, James, I like to be a little bit more conservative, okay? So let's say the investor said, James, I want to do the 310, and what I want to do here is the 305. Now, we're in the margin account, okay? Now, when this account was started, I just want to kind of give us some perspective on risk differences, okay? Let's say when we first got started at $25,000, we said, hey, we're willing to risk, let's say, 1%. Well, $25,000 at 1%, the risk was $250 a trade, okay? Well, if the portfolio does go up in value, and we're not saying that all this is for everyone, okay? Some of the trade examples you might not agree with, or strategies you might never consider. But for our account, that's what we're showing. Now, when I say our account, we're talking about a paper money class account. 35,000, 1%, it's now 350. Dramatically different? No, okay? But it's $100 higher than where it was a couple months ago per trade in terms of risk. So when I go look at, let's say, considering, let's say, the 310, 305, if I pull this up and say, could this margin account do this trade? Well, and by the way, the reason why I bring that up is if we got a $1.87 credit, we got a $5 wide spread, confirm send, what you're now going to notice is we could do a one contract where in the beginning of the year, we couldn't do that. In the beginning of the year, we could only risk $250 a contract, or trade, I should say. And now, since the balance has actually gone up, that doesn't mean all of the trades were good for everyone, okay? It's only paper money. It's demonstration purposes only. I've said that. And what you're now going to see is it now can actually do one contract, okay? Now, if you take a look at this, and that's important to understand, if your balance goes up or down, that's going to change the risk that you can take. That's my point of the comment, okay? So do not think that the dollar amount is staying the same. That dollar amount of risk that you're taking can change based upon your balance value. Now, what I'm going to do is going to do one contract. We're going to go confirm and send. Now what we're going to see in this case is we have a break-even expiration. This is not today. This is at expiration. Get a max profit, max loss, note the commission. Now, if we do this, we're going to send this in the margin account. Now, the quickness of this, we're also going to set an alert. Now, remember, an alert is not saying that it's going to get in. This is like, I don't know, like let's say on the outside of your garage, you have light sensors. Something moves, the light kicks on. That's the way I like to think about this. Or there's activity at your door, right? Your front door. Well, what I'm going to do is I'm going to kind of draw that diagonal line. And what I'm going to do is I'm going to right click on this and I'm going to say, look, if we get at or above that resistance line, we're going to kind of put a little asterisk there, add potential long call vertical. Why the long call vertical? Why the short put vertical first? It's a simple answer. Short put verticals are about probability. You have a lower break even. If you choose a long call vertical, you typically have a higher break even. And it's not positive time decay. So short put vertical, positive time decay. Short put vertical, lower break even. Okay? Hence the reward is less than the risk. Hence probability. You take the opposite of that, you get long call vertical. You pay for it. You get a higher break even. You don't have positive time decay. You need the stock to move up somewhat to become profitable or to get to that maximum gain. We want the stock above both strikes on the long call vertical and the short put vertical. That's the goal. So if I now say create alert, I'm saying, look, if we get above that resistance level, if we start to see this fill in the gap, which we've already done the first level, okay? Now, when you say first level, what do you mean by that? Well, the first level is it gapped down to here. We already closed above that, and it did that in a day. Where's the second level resistance? The second level resistance is where it gapped down from, and we're knocking on the door of that right now. Now, if you take a look at this, so we're going to keep an eye on that. We could say anything above 331. I put it a little higher in this case, meaning about 1%. Now, the question was on the expiration. Well, the expiration was the 19th of September because our examples in class are really based on 20 to 50 days to expiration, monthly options as a starting point to look and see and check liquidity, okay? Now, the other one I want to kind of go back to is if I look at FedEx. Now, if you look at FedEx, this is kind of one that's been a little interesting as well. FedEx, if we take a look at this, now again, we talked about transportation, right? Now, a couple months ago when we kind of had the announcement on tariffs, man, we don't know what's going to happen, okay? And there was a lot of talk on recession, tariffs are going to impact the consumer, prices are going to go up. You know, it's kind of still going through the pipeline. It could take months, right? Now, that doesn't necessarily mean the investor has to sit there on their hands, but it can cause wider price swings on stocks. Now, if over time it's maybe not as feared or there's data to support that maybe it's not as feared as expected, well, some people try to use maybe the negativity or the concern as a buying opportunity, okay? Now, why are we bringing this up now? Well, let's go back to kind of what happened post the earnings. Now, this one's a little interesting because there was a gap down right there, and we could see that. And remember what I said to you, if the gap down day is a red candle, draw the line from the open. But in this case, the gap down was a green candle, RIP, meaning it closed higher than where we opened. It doesn't matter. The moral of the story is we just want to say where's the top of the body of that candle, right there. So if it doesn't matter if it's a red candle, it'll be at the open price. If it's a green candle, it'll be at the closing price. Now, I want you to kind of notice something. If we take a look at this, it rallied up and was able to get above there for about 2-3 days and then fell back down. And it actually was the first breakout did not hold. Now, a lot of people get sensitive, okay? Now, how many of you are sensitive people? I can be sensitive. I'm emotional sometimes. I admit it, okay? We're all emotional. If we're tired, we can be emotional, right? Maybe some people not so much. It just happens at any given time. Now, here's the deal. If we take a look at this, we see the little run to the upside, and then it fades back. Now, notice here that we did not come down to the bottom of the channel. Why didn't it come down to 215? Why did investors buy, okay, in the middle of the channel. Who does that? Okay. Now, I want to kind of go back to where we gapped down from, right? So this was the first level of resistance, that 230. Where did we gap down from? Well, we gapped down from right at about 244, okay? So if you take a look at this, zoom in now, let's kind of widen this out so we can see this. So the 230, that was our first line of resistance. Let me put in a white line there for us, okay? 230. If we break above 244.51, that actually means that the stock has soaked up the negativity or the selling pressure of the earnings gap down. Now, if all of a sudden the economy is not as much into recession or doesn't cool down, manufacturing numbers, service numbers, GDP numbers, maybe they, for example, even cut the rates 1 or 2 times in the next 6-8 months, etc., could FedEx actually start to reverse a little bit? We're trying to make a play in the transport space. Well, let's kind of talk about this. Now, let's say the investor said, James, I want to buy the stock, potentially thinking that that stock might get above that resistance. Already got above the first level, but if it breaks out again. Now, sometimes when people get in, they're nervous. They say they're willing to take risks. But when it really comes down to like rubber meets the road, well, you know, it depends. It depends. Let's wait and see what happens. Other people, not so much. What I'm going to do is going to go buy custom, okay? And what we're going to do is we're going to do a position on this. Now, let's say we said at the most 35,000. Let's say we put in 10% capital. At most 15% capital. Well, if we did, let's say, and I got to double check that we could, 35,000, if we did 10%, it'd be 3,500. If we did 15% of that portfolio, it'd be 5,250. Well, how much cash do we have left? And so this is where we got to get into the numbers, okay? We got to get into the numbers because if we look to do a trade, does the paid money portfolio have enough money to do the trade, okay? Well, if we did 15% capital of that 15% position of a $35,000 portfolio, it'd be $5,250. Now, I know what you're thinking. I wish I could do more. You know, have more money in the portfolio, save more, make more, the whole 9 yards, okay? So what we're going to do is we're going to do a half position on this. We're going to do, let's say, $2,650. $2,650 is half, or 61, if I did cut that in half, okay? It'd be $2,625. I was off by 25 bucks. Now, what are we doing here, okay? Well, our example is going to show that it's going to buy about 10 shares of stock. Now, what we're talking about is dollar cost averaging. In other words, if we have a setup, okay, let's say the investor gets in half the position. They don't have to get in half. They might do a third, okay? They might do a quarter, right? Depends how much evidence you want to see to try to build a position. Well, if we just did half, let's say the investor says, look, I want to take $2,625, buy some shares here, which is about 10 shares, and I want to buy them right into the area of resistance, thinking that the price might go higher. Example given when we take a look at this, if I said, well, where's the stop potentially? If we take 230, okay, 21 less 2%, it's going to give us 225.60. So I'm going to go down to the stop, 225.60, stop, day GTC. Where did you get that? I just took the gap down, where we gap down to. Follow that line all the way over, right there. That's why that line is, we putting the stop right below that, okay? Target level. If this stock were to go to the upside, where might it try to go to? Now, when you have some consolidation like FedEx had, there could be multiple spots, okay? Now, normally when you're thinking about doing a trade, you're thinking, hey, could this stock go up maybe 6, 8, 10%? Why? Well, because you might be risking 6, 8, 10% of the entry price, And so you're probably wanting at a minimum a 1-to-1 reward forecasted ratio. Okay. Now, if this stock actually broke to the upside and went to 268, how much is that? What percent is that? Well, if we went up to that 268, that's 10% from the current price level. If I said, well, maybe it's not as high, maybe we would just went to 263, it's going to be right at about, if we went to 263, that's going to be right at about 8%. Okay. So when you're doing a trade, you like to look back on the chart or the fibs and kind of say, could the upside maybe go 6, 8, 10% to offset or forecast a potential return to offset what the risk is. So what I'm going to do is I'm going to put a target right about 263.25. Now, if JP has a friend named WW, if WW has a friend called JP, okay, and JP says, I wonder where WW would set the paper money target. I want to sell before JP or WW gets out. Joking, just making sure you're listening. But you kind of have to think about where those other traders might see it. The reason why I wanted to have a little fun with you there is some investors are trying to undercut where they think other investors might sell. They're trying to kind of think ahead of time. Where might they try to get out? Where might I get out, the investor says. They're trying to undercut that. They're trying to sell a little early so that way they can actually get out before others, okay? This is the same idea of saying, hey, we want to go out to dinner. Let's say we want to go to Olive Garden. When do we think the circus is going to show up? Probably 5:30, 6:30. We don't want to show up when the circus is going to be there because we're going to have to sit in line. It's going to take longer to get the food and so on. Here we're saying, nah, we're going to come at 4:45, 5 to get ahead of the crowd. So technicians are trying to sell ahead of the crowd, buy before the crowd shows up, right? Now, what I'm going to do is go confirm and send. Now, what I'm going to do here is I'm not going to set the entry for the second trade because I want to get to other things, but I'm going to right-click right above the white line. If I right-click above that white line, create alert, what we're going to now do is we're going to put a little asterisk, a little note to self. Add 26.25, which is the other half of the position. And there it is. I like the note because it makes me remember back to what was the initial idea. Now remember, this is just saying, look, if FedEx gets at or above this price, let us know. It actually can trigger on your let's say your watch, your phone, your tablet, shoot you an email. You can set it up in the profile. And also it will just flash also right up here on the messages or just right up on the platform itself. You'll see a little message pulls up. If I go create, there it is. Okay. So the reason why I taught this here today is there could be some stocks that have a negative reaction. Has been some stocks like Tesla that had a negative reaction, but are starting to show some signs of reversal. Okay. When stocks gap down, that might be negative in the shorter term, but that might not necessarily be a bad news for everyone, especially if someone is looking to get in and or looking to maybe add to the position. Now, I want to go back to just real quick. The question was asked on TXN. So let's kind of say that someone says, hey, James, I was looking at Texas Instruments and I was kind of wondering, is now the time to consider entry? That's what the friend says to you. Based on what we talked about here today, what is your answer? Now, remember we said, if we look at the gap down, which we can see, it gapped down from there to here, okay? So that's number one. We've got to see the gap. It should be easily seen. Second, we want to say is that candle on the gap down, is it green or red? If you said, I'm confused by kind of where you draw the line, we could simplify and say whether it's a red candle or a green candle, we're just going to draw the line from the top of that body of the candle. If it's a red candle, it's the open. If it's the green candle, it's going to be the close. So if I just follow those kind of that practice, if I looked at this and said, do we see an entry to get in based upon what we talked about? No, we don't see an entry. Where's the setup? Well, you got to get above 194.74. Until we get above 194.74, we're still trying to create a base. We just made a low on Friday. So if we said paper money, is it going to trade this? It's not consistent with what we talked about because we're not even above that first level yet. Now, the reason why we also talk about this is many of us like to trade channels, right? Well, if the stock can get above 194.74, it might try to travel the width of the channel. Now, you really have to talk to people who really do bearish trading in general. I have a history of bearish trading. I started the stock market back in 1996, specifically in 1998, a lot in 2000, 2001, 2002. So back then, there was a lot of bearish trading. The significance of when the price gets above 194 is, number one, bullish traders could be looking to get in. That's number one. Number two, current investors could be adding to the positions if it getting above 194. And then smart bears say, look, if we get above that level of resistance, they want to get out. And if they're using stock as instruments to short, they need to buy back, example given, to get out. So there's really three things that could be happening if the price can get above 194. That's why those reversal moves to the upside can be so significant, okay? So sometimes you have to kind of know when the stock is not giving you the signal and where you would be saying, hey, if it can get above here, that would be of interest. But right now, no thank you. Now, let me go back to SMCI in closing here. We talked about SMCI about a week or two ago, and we kind of went through kind of looking at some examples of a stock. Now, I want to go back to this and just take a look at when was this trade place? I said 2 weeks ago, a week or two ago. It was placed on the 15th of July. What is the trade? Well, you got a 49 short put and you got a 36 put, same month. Now, when the strikes are widened out like that, what do we call this? A short put vertical? Well, we put one word in there, short wide put vertical. If the strike width is like that, a lot of investors would say, James, this is really a cash secured put with some downside protection just in case. Many investors like to actually do this in an IRA account to try to reduce their buying power and actually make sure there's a max loss built in. Now, on that trade, we're sitting here at 65%, okay? Now, what I want you to kind of notice is let's kind of look and see if we can add to the position. Now, the other interesting thing about earnings is when you come into the earnings, which by the way, the earnings is going to be next week, when does the volatility tend to be at the peak state? The answer, typically, okay, normal distribution, we'd probably say 2 to 3 days from the earnings. That's when it's at typically the peak state of volatility. So volatility is high. Well, does that create a potential setup? Now, by the way, where was that on the chart? Well, the 15th was right here. So this was kind of playing your little gap down, okay? And what you're going to notice is there's gap downs there. There's gap downs there. Old gap downs, resistance, can turn into new potential support levels and or vice versa. Now, if we take a look at this, I'm going to go back to the trade tab here. And what we're going to do is we're going to go down to the September. Now, this is the August, okay? We're going to go to the September. And the last trade we're going to do here is we're going to look to try to sell the 55 with a 34 delta. And we're going to sell the 55 and then we're going to buy the 50, okay? Now, what we're going to do in this case is we're going to sell the 55 and buy the 50. Now, let's think back to what's the risk the portfolio could take or willing to risk. By the way, it could lose it all. Well, you got a $5 wide spread, $1.85. It must tell us the 315. So how many contracts could the paper money account do? It could do one contract. Now, this is the danger, okay? When you feel like you've been hot, like James, I can't tell you the last time I lost. And my analysis has gotten so dadgum good. Forget the position sizing. I'm going to pump this to 2 or 3 contracts. Man, pride comes before the fall. As soon as you get outside those kind of the lanes, so to say, of position sizing, all of a sudden you start taking losses, and your confidence is really coming in at maybe the worst time, usually when the VIX is low. Okay, so we don't care about confidence, whether it's low, high, going to go back to the position sizing. So for this trade example, notice the break even there. It's $5 lower than where the current price is. We're going to send the trade. Your homework assignment is I want you to be watching out for these gap downs. I want you to start looking for the gap down, draw the line at where the bodies of the candles are, and start to watch for reversals. With so many earnings out there, there's bound to be examples. If you find some, share them. and I'll make sure that we bring some up as well. Okay. So I thought that was kind of a time-sensitive discussion on gap downs. And remember, with what we discussed here today, was done for example, illustrative purposes only. Thank you, Ben Watson, for answering those questions in chat. Cameron May will be coming up next, talking about cash secured puts and covered calls. And this has been the session on trading with technical indicators, focusing on gap down reversal patterns. With that said, have a great day. Take care. Bye-bye.